Hello and welcome. This is Gordon De Silva from the award-winning firm Gordon's Knight, and I'm here to bring you my take on the budget 2016, March 2016 with George Osborne. I'm going to go through the bits that are relevant to clients more than just everything. So I'm going to skip over bits in our report. You will be able to download the report on our site, but if you prefer to listen to it or read it and watch it, then you can watch this video. I'm going to break this into various parts. This one is going to be about personal allowances and income tax bands. So let's look at personal allowances. This has already been announced, 2016-17, it'll be £11,000. We do a calculation for your salary, and this is based on this allowance. But remember that national insurance thresholds, where national insurance on payroll kicks in, is much smaller. I think it's about £7,000 compared to the £11,000 for tax. So while you may get zero tax, you may end up paying 25% national insurance. So our calculations are based on minimizing the tax hit on you personally and your family. And of course, next year we've got some other dividend things which we're going to talk about later. So shortly you'll be getting an email asking you to approve the 2016-17 payroll figures. Please do that as soon as possible because we need to get it in play. Remember that if your adjusted income, that's after pensions and everything, exceeds £100,000, the personal allowance of £11,000 or £11,500 in the following year will be reduced by £1 for every £2 over £100,000. This has been around for quite a long time, and it gives an extraordinary effect. The effect is that it will increase your effective rate of tax to 60% on income between £100,000 and £122,000. Now, there may be some of you thinking, "Oh, this is too high," but it's a good income to have as a business owner. You work really hard. You put a lot of risk and effort into your business. You provide an extraordinary value to your clients. You deserve to earn 100, 150, 200,000 pounds. And if you don't, many of small businesses are trapped in what we call this squishy middle, this glass ceiling of between 30 and 60,000 pounds income. And often it's not enough to add a greater quality of life, better holidays, better homes, better cars, better family life. And unfortunately, when that happens, you can quickly become despondent. And often it's a tiny piece or tiny pieces that would take you above into the 100,000, into the 150,000, into the 250,000 pound income bracket, and that's where you deserve to be, and that's why our profit multiplier program works on that. So if you are heading towards the 60%, by the way, please call us, because if your income is between sort of 100 and 120 and 130, then you probably deserve to do something about it, because why would you want to pay 60% tax if you can avoid it? Now, if your income is 200,000, 300,000, fair enough, you're way above that, and it's, this small band is not going to make a massive difference. But if you're at 130, 120, then on that 20,000, you're going to be paying 60% tax. Now, what if you put that £20,000 to bring it under 100 into a pension or a small enterprise investment scheme, and the cost of that would be dramatically reduced because the opportunity cost would be paying 60% tax. So that's the thinking that we bring. That's why we spend so much time with clients and working with clients on their affairs, because the time we spend can have a dramatic effect on their income and their take-home income, their wealth, and their family's wealth. Let's look at income tax bands very quickly. The 20% band will be £32,000. Remember, this is in addition to the 11,000 tax-free band, or next year 11,500. And in the following year, it's going to be 33,500. That means that you will pay 40% if your taxable income exceeds 43,000. That's the 32 plus the 11 is the 43,000. If your income exceeds that, you'll be paying 40% tax, unless you're on dividends, in which case the pain comes in at 47.5% tax, and even the 20% becomes 27.5% tax. That's a 30% increase in tax, but more of that later. Remember that the 40% top rate continues to apply to taxable income over £150,000. They're not proposing to put that up. There are some changes to ISAs, and I'm not going to go through that. And pension allowances are reduced, and I'm not going to go through that because it is, if you're right for a pension, then you'll ask me for a referral, and I'll introduce you to a couple of financial advisors who are really good at what they do and professional and qualified to take your money and follow your instructions on, either cautious or moderate or risky investments, so that you can do something more than the banks are offering you, maybe 0.5% or 1% or something. So let me leave you with that. And I'm going to talk a little bit about the £1,000 saving income, because if your interest is £1,000, and I just say the interest is 1% from a bank, you'd have to have £100,000 in cash in deposit. Not many of us have that sort of money, but if you do, then we are going to be getting £1,000 of interest tax-free, unless we are higher rate taxpayers. And if we're higher rate taxpayers, that limit is brought down to £500. So those of us who have a significant amount of income and interest, then our tax-free element is only going to be £500. It's better than nothing, but keep that in mind. Remember that if your income is over 150,000, which I hope it is, then you get taxed on all your interest income. Well, that's fair enough. You've got enough. We can make more income than what we lose in this. £500. It's not worth concentrating on £500 if you're making 150, 250,000 pounds, because it's easier to make an extra £5,000 than it is to try to save £500 in tax, isn't it? So what will have to happen for this to happen is the banks are going to be paying you interest gross from April 16, which means that there's a whole range of things that may need to happen. You may need to look at your tax returns and what you declare in your tax returns. If we do that for you, please make sure you put all your interest earning accounts in with us, because omitting this can have a dramatic effect on your tax bill. Okay, that's it for that section. I'm now going to go on to the things to do with companies, so we'll reconvene on that video in a couple of minutes time. On the next video you can log in, it'll be introduced again, but you can skip the first few minutes of the introduction if you wish.